Let's turn back to the banks, ending the day mostly lower, except Citi after posting mixed fourth quarter results. Let's bring in RBC Capital Markets' Gerard Cassidy and our own Leslie Picker. Leslie, a lot of noise in these bank reports, the numbers, and trying to understand if there's any overall message for investors and what to look for heading into next week, and especially for the regional bank earnings has been difficult, at least for me. What's your read?
Yeah, no, you're exactly right. It was definitely a noisy quarter. A lot of that was due to the FDIC special assessment, which was levied on the banks. It's basically what they owe the FDIC insurance fund to make up for the shortfall that they endured as a result of some of the regional bank failures from last spring. In terms of the read-through, I think for the regional banking community, a lot of it will stem from kind of the outlook for net interest income, which was a mixed picture, although largely across the street very asset sensitive. So when you see rates go lower, as they did in the fourth quarter, that is a headwind for net interest income, that profitability metric for loan making. So the regional banks are even more exposed to that trend. So I think that's something that investors will be acutely focused on as they start to report.
Okay, so Gerard, I think it was Moynihan who said that higher rates and the stability generally good for them. Does that read across big banks? Is it just for big banks, or how should we think about how that affects the regionals?
John, I think you put your thumb on it. It's beneficial for all of them. In fact, what I thought was interesting today, just about every bank, when they gave their guidance for 2024 net interest revenue, they were using the forward curve as their guide. The forward curve right now is calling for 6 Fed fund rate cuts. And if we don't see the 6 Fed fund rate cuts, let's say we only see 2 or 3, that higher for longer scenario then perseveres. And to your point, John, that's very positive for not only Bank of America and the other large banks, but for the regional banks as well.
And so, I mean, I know this is an arbitrary number, but I've been looking, and the KRE closed today above $50, and so that makes a straight month that it's been there. And I wonder if it stays there through earnings season. Or, Gerard, do you think there are enough smaller banks that have certain types of risk, unique risk perhaps on their balance sheets, where we should prepare for more turbulence?
I'm not too concerned about unique risks for the regional banks. Certainly the risks have been identified throughout this year. With commercial real estate office properties. We saw more of that today in terms of the bigger banks building reserves for those properties. But everything else from a credit perspective remains in good shape. So we're not likely to see any real surprises on the risk side. What we saw in the spring, of course, was idiosyncratic to Signature, Silicon Valley, and First Republic. That's all behind us, as Leslie pointed out. And so I think as we go forward into next week, it's really going to be about when does the net interest margin inflect for the banks, and when does net interest revenue start to grow? And I think we're going to see that for most banks, it's going to be within the first half of next year or of 2024.